Welcome to Yahoo Finance this Wednesday, July 30th. I'm Josh Lipton, along with executive editor, that would be Brian Sozzi. We're just moments away now from the Fed's decision on interest rates. Let's get a quick check on the markets here ahead of that news. Looking at your popular averages, the Dow, I'm going to call that basically flat. You're up 20 points. The S&P 500, your broad gauge, you're up about 0.2%. Your tech-heavy NASDAQ up about 0.5%. The Fed's decision coming soon. Brian, I want your quick thoughts on this. Obviously, Brian, the FOMC, our central bankers, our esteemed policymakers, the expectation, Brian, is
they are esteemed.
They are going to hold rates steady, unchanged. Jay Powell has said, listen, I'm a central banker. I follow the data, right? And I'm data dependent, and I got a lot of moving pieces here, Brian. I got to see how trade policy is evolving and changing. Got to wait and see.
There's two ways to look at this. One, from a market perspective, I think this is a market that knows there is unlikely a rate cut coming, but they need a bone. Jay Powell tossed the market a bone. It's a market trading at records, damn near high record valuation, especially in big cap tech names. They want to hear that rate cut maybe coming in September, and then it could be signaled even more at the Jackson Hole event in late August, which is very important. But I will say this, Josh, the CEOs that I talk to, nobody's talking about a rate cut. I'm not saying they can care less. They're more concerned about tariffs, because we have learned this week with earnings season, tariffs are eviscerating corporate financial statements. And this is a market that says that they have not been a problem. I'm here to tell you tariffs have been a large problem to second quarter earnings for very large companies.
We'll see what Powell has to say about that. Also interesting, dissents. You could see one, maybe even see two. That would be very unusual, Brian. The Fed's decision is out, and our senior Fed reporter, Jennifer Schonberger, bringing us the details. Jen, what do you got?
No change. The Federal Reserve holding rates steady in the range of 4.25% to 4.5%. But two Federal Reserve governors, Chris Waller and Michelle Bowman, dissenting, preferring to cut rates by 25 basis points, underscoring division within this Federal Reserve over the impact of President Trump's tariffs on inflation. This is the first time in 30 years that we have seen two Federal Reserve governors dissent simultaneously. Now, there were some changes to the policy statement. Notably, officials downgraded their assessment of the economy, saying that economic activity has moderated in the first half of the year. That is a downgrade from characterizing the economy as, quote, solid back in June. They acknowledged the swing in net exports that are impacting GDP, just as we saw second quarter GDP come out this morning, and acknowledged that taking first quarter and second quarter GDP together, we have seen growth moderate. Now, they reaffirmed their view of the job market, calling it solid again, also noting again that inflation is somewhat elevated. Officials also noted that uncertainty around the economic outlook remains elevated. That compares with a statement back in June that uncertainty had diminished but remained elevated. Guys?
All right, thank you, Jen. So, Sozzi, quick wrap there. They do, as expected, hold rates steady, unchanged. Couple key points here. One, two dissenters, my friend. That is unusual.
Like you hinted?
That is unusual. I was reading it. That hasn't happened since '93.
Yeah.
It has been a while. As Jen's saying, they're kind of signaling this disparity, really, that we're seeing there. Downgrade the assessment of the economy. Activity has moderated. Reaffirm view of the job market as solid. Inflation somewhat elevated.
That's the phrase that has left an impression on me. If you're a market bull, the last thing you wanted to hear or see on this press release, quote, inflation remains elevated. Because my initial thinking is Jay Powell is going to get up to the mic. He's going to tell reporters that he remains concerned about inflation, so much so, in large part because of tariffs, so much so that that rate cut in September may not happen.
You know who I always feel bad for in these pressers, can I tell you? I feel bad for the reporter who has to ask Jay Powell about Trump. And you have to ask. You would ask, I would ask.
Him on the record.
You have to ask. But it seems to so irritate Powell. And irritate Jay Powell, he's kind of scary when he gets irritated.
Well, I hope Jen Schomburger asks.
That'd be great.
I mean, she's in the room.
Yeah, she should go. I am interested in this presser. I guess my interest is, does he does he stick with the mantra has been, I'm data dependent, right? Or to your point, is he willing to get a little bit more aggressive, signaling, to the market, yeah, okay, a cut could be on the way in September.
And look, I'm looking at the Dow right now. As soon as that statement came out, you saw it tick down just a little bit in response. Now, I'm not going to sit here and say it's all because of inflation remains elevated, that comment in there. But this was not necessarily a great statement if you're a market bull and you've been trading up stocks to record valuations.
You know who we should ask about that for market reaction? I can tell you right now.
Okay.
The man, the myth, the legend, Yahoo Finance's Jared Blikre is going to bring us up to speed. How are the markets reacting, Jared?
It is a small reaction so far. As you can see, the Dow Jones Industrial just ticked negative. Now it's positive again. I will show you the chart. But since that 2 p.m. Eastern Time announcement, that is a very small move. In fact, we had seen a pretty small move today, both to the upside and the downside before that. So the real fireworks is going to come at 2:30 p.m. when Powell takes the lectern, as is usually the case there. So you can see the NASDAQ composite had been a little bit more in the green right by those highs of the day. It's ticked down ever so slightly, still up about 37 basis points or just over 0.33%. And here's the S&P 500, very similar chart here, holding on to gains of just under 0.2%. And let's take a look at the Russell 2000. That has been the leader of the day. That is up almost 1%. Not much of a reaction right there, but we got to go to the bond market. And it has been a heavy news day. And by the way, we also have earnings, big earnings after the close, but let's focus on the Treasury move so far. We're not seeing much in Treasury futures, either to the upside or downside. We are in red territory, which means yields were a little bit in the green just prior to the announcement. But only this morning, we got a statement from the Treasury regarding their next refunding. They are going to be calling and they're going to be buying back bonds on the long end. And so that's going to provide more liquidity to the Treasury market, gives the Fed a little bit more operating room with quantitative tightening. We might get a question or two on that. But again, not seeing that much movement in the futures either. Finally, I will just close with gold. Not seeing much movement either there. So I'll send it back to you on that, Josh.
All right, thank you, Jared. Here with more now on the Fed's rate decision, we got JP Morgan Asset Management Global Market Strategist Jack Manley, along with EY Chief Economist, that would be Greg Dacco. Gentlemen, welcome to you both. It's great to have you both on set. Greg, I feel like you're the economist on set. We should start with you, Greg. What do you make of the decision? Greg, was it the right decision by the Fed?
Well, I think the Fed is on hold, and that was largely expected. We did see, however, some comments as to the evolution of growth momentum. The fact that they noted that growth has moderated is very important because it highlights what Brian was mentioning earlier, that tariffs are starting to bite. They're starting to have an effect on inflation, leading to higher inflationary pressures, which are curtailing consumer spending activity and leading businesses to adopt more of a wait-and-see approach. So growth is moderating, and uncertainty, very importantly, remains elevated. We're seeing it right now when it comes to tariff announcements and the August 1st deadline. There are going to be more tariffs. That's going to further erode demand as we move forward. Whether or not that's the good decision, I have been arguing that the Fed has the room to move from a moderately restrictive monetary policy stance to a more neutral stance, because I believe the tariff shock will be a one-off effect. And underlying all of these inflationary pressures, you still have strong disinflation from shelter, from reduced wage growth, and from strong productivity growth. So I think there is a window, and I think that's what Governor Waller and Governor Bauman are signaling, a window to start easing monetary policy in September.
Jack, bring you in here. You agree with Greg's call? There's a window?
Yeah, I mean, generally speaking, I think there is. Rates have been high. They've been high for a while. And I think, in some cases, there is an argument to be made that why not cut interest rates from where we are at the moment? You are seeing some softness in the labor market. I would disagree with that assessment that we heard in that statement. Yes, the unemployment rate is low, but if you look at what's going on with the growth of the labor supply, the changes to immigration policy, solid. Right. I don't think it's nearly as solid as they're mentioning. A strong GDP print out this morning, but a lot of that on trade data. Consumption still hanging in there, but a little bit softer. I think there are some economic reasons for the Federal Reserve to consider lowering interest rates. I think the other thing to point out here, and this is kind of a crackpot take on my behalf, is that putting the market aside, which may or may not need lower interest rates, putting the economy aside from like a labor market, inflation, GDP growth, it may not need lower interest rates. You know who does need lower interest rates is Uncle Sam. Like, we got a lot of debt out there, and there is a maturity wall, and this stuff needs to get refinanced, and it is going to be very, very difficult to refinance it at higher levels. And the argument there is, well, why not cut interest rates by a little bit? Because here's that crackpot thing that I mentioned. I don't think the Fed's got nearly as much control over the economy as it thinks it does. Inflation goes out of control in 2022. The Federal Reserve panics, raises rates more aggressively than it has in a while. Inflation all of a sudden moves back lower. Serendipity, right? I mean, that's not interest rates. That's not rate policy. Like, Jay Powell wasn't the captain of the container ships moving the energy across the way. He didn't call up Xi Jinping and tell him, to abandon zero COVID. Higher interest rates had nothing to do with pushing inflation down in the aftermath of 2022. And so maybe we lower by a quarter of a point. Maybe we do have that room. Maybe the economy doesn't react the way that we think it does, but it's great news from a borrowing perspective. So I think a little bit more fuel for that fire.
Well, who else, Greg, I would think would benefit from lower interest rates? I want to get your take on this. Just regular mom-and-pop Americans. How about small business owners? What kind of impact would that have?
I think that's very important to mention because it's not just about short-term interest rates. It's also about long-term interest rate. And the yield on 10-year treasuries is key in terms of lending at the corporate level, but also at the consumer level. When it comes to mortgage rates, for instance, and allowing for affordability to essentially grow in this environment where the housing market is essentially frozen. So I do think it's important, but I want to stress one point that is often omitted. This rationale for Fed easing needs to be explained in a clear way. It cannot have a political undertone, because if it does have a political undertone, according to which essentially the administration would be pressuring the Fed to ease monetary policy, then the risk is actually that long-term rates decouple from short-term rates. Because there would be an expectation that the Fed would not be reacting to economic data, you could have a de-anchoring of inflation expectations. You could have an environment where essentially there is a loss of credibility in the Fed as an institution to control inflation, and that could actually pressure long-term yields higher, way on the US dollar, and lead to the very opposite effect that is desired in terms of a potential stimulus to the economy. Again, I think the argument that Waller has brought forward, that essentially we have strong underlying disinflationary pressures, that inflation expectations are well anchored, that we're seeing essentially a moderation in the labor market that will reduce the risk of second round effects on the inflation front, and that tariffs are likely to be a one-time cost pass-through phenomenon. Those are arguments that make the case for some Fed easing. That's not political. That's really based around a point of view around economic data.
Jack, Greg just mentioned Wall there. Another important wrinkle, we had 2 dissents. I mean, I was reading, you haven't had 2 dissents since 1993. What do you make of that? What does that signal? What does that suggest?
I'm going to try not to read too much into the political undertones of what's going on right now, because to your point, that's just something you have to avoid. It's a minefield. You're always going to upset somebody. I think it is just very clearly an indication that nobody really has a firm grasp of what's going on in this economy right now. There are too many moving parts. There are too many things churning underneath the surface that are influencing the trajectory of inflation, of the labor market, of GDP growth. There is no obvious playbook to use right now from a central bank perspective. And if that's the situation, then I think it goes without saying that you're going to have some people that have differing views from what the consensus might be. And I think that's probably fine. It's healthy, and it is an indication that maybe we will be seeing a little bit more wiggle room for easing, perhaps in September or later this year.
Greg, if now attention turns to the presser here, I'm curious, what are you listening for from Jay Powell?
I want to see where he stands, because there are really 2 camps. It's a fractured FOMC. We know from the June dot plot that there were 7 policymakers that essentially wanted the Fed to stay on hold through 2025, and 8 that wanted to favor 2 rate cuts over the course of the year. So I want to see where he stands and whether he's leaning more towards John Williams, the New York Fed president, which argues that the Fed still has ample time to evaluate the economic impact of all of the administration's policy changes, or whether he leans more towards Waller and now perhaps Bauman in terms of considering the need for monetary policy to be neutralized from a slightly restrictive stance to a more neutral stance. I think he will provide some context as to where he stands, and that's going to be, in my opinion, the key element in this press conference.
Jack, same question. What are you listening for there?
Yeah, I think it'll be really interesting to hear Powell's take explicitly in response to questions about what's going on with the economy, how he's weighing the pros and cons. But you know what? Maybe I'm jaded. Maybe I'm just sick of talking about the Fed, because that's all I've been talking about for years and years and years at this point. But I've stopped believing that I'm going to get anything particularly meaty out of any press conference outside data of those quarterly summary of economic projections. How often does Powell come out there and really open up his heart and tell you exactly what he's thinking? I mean, he has to, by definition, play things close to the chest. I like seeing the SCP. We got that back in June. We won't have another one until September. Everything else is ephemeral. Everything else is going to be changing. Everything that he say is liable to be changing at the next meeting. I want to really focus in on those concrete things. So you know what? This might be an interesting press conference. It might be entertaining, depending on some of the questions that are asked about the politics, about stable coins as an example. But I don't think we're going to get any real clarity as to how Powell is thinking. I think we're going to have to wait until September.
Maybe Jack, maybe it's interesting and entertaining.
Yeah.
Who knows?
Could be.
We're waiting to see. Jack, Greg, stick with us. We're still in Fed rate decision day mode here, and we're carrying Fed Chair Powell's remarks live. Stick with us. You won't want to miss it. Coming up. The Fed holding interest rates steady just moments ago. For more reaction, I want to bring in now Chip Huey, Managing Director of Fixed Income at Truist Wealth. Chip, it is always great to see you. So the Fed is expected, they hold rates unchanged here. We did have two governor dissents, unusual, Chip. Downgraded the assessment of the economy, activity is moderated, reaffirmed their view of the job market solid. Inflation, they call that as somewhat elevated. What do you make of it, Chip? Give us your review and response.
I think this is exactly what we expected. We expected that a lot, certainly for the Fed not to cut rates today. I don't think that the evidence for cutting rates, if they hadn't already prior been cutting rates, that case had not really built over the last 6 weeks. So this is largely in line with what we expect. And clearly the Fed is not comfortable with the uncertainty around tariff, what the impact is on the economy, what it is on inflation. So holding steady is certainly what we expected here today. What
do you expect to hear at the presser, Chip? You think Powell kind of sticks with his mantra, he's watching the data, he's data dependent, he's got to see how the trade policy evolves, or no, you think, Chip, does he take this opportunity, maybe he gets somewhat more aggressive, he kind of signals, hey, the cut could be on the way?
I do think that it's going to be a lot of more the data dependency type language that we've heard for a long time. I think that that's going to continue. I think what will probably be most interesting is, and he will certainly be asked about it, is to address the two dissents in the room, which, as you mentioned, Josh, it is unusual. I don't think it's a bad thing. I really don't. I think it signals healthy debate. It is a fluid economy. It is an evolving situation. It's okay to have dissents in and of themselves. I think that the context that he may provide there could be really valuable and really interesting to listen to. It's certainly what I'll be listening to.
Chip, when do they cut? What is your base case? What are you telling clients?
When they cut?
Yep.
I think the idea that we are seeing more softness in the labor market, not weakness, but it is softening. If that case builds over the next two prints that we get, we've got a big one on Friday, right? We'll be watching that closely. I think that it will give the Fed the breathing room to start slowly lowering interest rates. So right now, we do expect the Fed to lower the rate, the Fed funds rate twice by year end. And again, in a cautious, slow fashion, acknowledging that growth not collapsing, but it is softening. Labor market a little softer. I think that they'll get that validation for that next move by the September meeting.
Do you think, Chip? Here's an interesting question. I want to get your take on. Do you think the market? And we're waiting for Powell. We're all going to be glued to what he has to say. One question is, do you think the market, though, Chip, in some way already looking post-Powell, through Powell to the post-Powell world when his term ends and Trump picks somebody more aligned with his thinking?
I don't think we're quite there yet. I think that day is likely coming. We do think that Fed Chairman Powell is going to make it through his entire term into May. I do think that the composition of the Fed that we will see by the middle of next year, it does matter. And so I don't think the market is really starting to price that in as of right now. I think ultimately that we will see that become more readily apparent as we move forward. And I think what's going to happen is that it'll be pricing in a little bit more in aggregate, dovish expectations as we get through year end, maybe into the early part of next year.
Yeah, it is interesting. But let's say, Trump has his pick and it's somebody you would expect to be more dovish and cut. How would the bond market react to that?
I think it depends. I think it'll be interesting to see how it plays out. I think that if the pick is someone that does seem committed to that inflation mandate, making sure that inflation is still under control and inflation expectations stay anchored, I think that you'll still see the front end fall and the yield curve steepen a little bit. I think where would be a more interesting reaction if there are questions around the commitment to that inflation mandate. And in that sense, likely you're pricing in more dovish expectations plus some questions around the inflation mandate. And therefore, I think you would probably see more volatility, a little bit more uncertainty, and then be a slightly steeper curve as well.
Last question, Chip, for the fixed income investors who are listening right now, what is your guidance? What's your advice?
Sure. So neutral duration, I think that the uncertainty that we've just discussed here for the last few minutes, it warrants staying neutral on duration, not being very, very short, not being very, very long. And also because the economy continues to chug along, and that's a good thing, that's a positive thing, the riskier corners of fixed income look really expensive right now. They cheapened in April when we had that sort of initial shock around tariffs, and there was an opportunity there in riskier fixed income. We actually upgraded our view in that period, added a little bit of risk there. But since then, those areas have recovered to the point where that risk reward is not quite as compelling. So we would be patient, focus on high quality. Those yields are still very elevated relative to the last 2 decades, which is extremely positive, and wait for those more tactical opportunities to add risk, as this unfolds over the next 3 to 6 months.
Chip, great to see you, sir. Thanks for your time.
Thanks, Josh.
The Fed holding rates steady at its July meeting. We have Esther George now, former president and CEO of the Federal Reserve Bank of Kansas City. Esther, always good to see you. So the Fed is expected they hold rates steady. Esther, first give me your take on that. Was that the right decision, Esther?
Well, I certainly supported that decision, and I think they telegraphed that pretty well, which is they were in a mode of waiting to see how the economy unfolds. And to be honest, Josh, they are really waiting to get some conviction around inflation to ensure that that is going to be coming back toward their 2% target.
When do you think we get that conviction, Esther?
Well, I think it's a great question. You're seeing the economy slow compared to last year. We see, I think, the uncertainty that has been plaguing the economy for the past few months playing out here. And the question is, the economy is still growing. People are beginning to understand to some extent how to manage their businesses in this kind of environment. So the things that are pushing, I think, as upside to that inflation story have to do with the financial conditions we've seen, which have eased since the Fed's last meeting. We continue to see a lot of deficit spending coming out of the government. We're going to have a lot more Treasury issuance coming out here. And the direction of travel is to deregulate. So there are some things here that I think the Fed has to keep their eye on when they are trying to develop that confidence and ensure their credibility around their inflation target.
Let's say you're in that presser, Esther, that's coming up here, which we're all going to be listening to very carefully. And you're a reporter, Esther. I just made you a journalist. And you have the chance to ask Powell a question or two. What would be top of mind?
So I think I'd want to know from the chairman to what extent they really believe the current interest rate environment is restrictive. It is getting less and less clear to me that this policy rate is really dampening the economy. Certainly, we know borrowers always feel the brunt of these interest rates compared to where they've been over the last 2 decades, frankly. But all in all, the economy continues to move forward. And so understanding the Fed's calculus, I think, around where the balance of risk is as we go into the September meeting, I think will be something I'd want to hear.
The political pressure, Esther, that Powell has been under has been intense. I'm curious to hear what you make of it. And also, Esther, just a more general question of how much that Fed chair matters when really, Esther, we're talking about, of course, 12 people who set interest rate policy.
Well, the Fed chair matters a lot. This is the leadership role for the committee, a very large committee, as you noted. It is one vote, but the real responsibility of this leadership position is to bring consensus, is to provide the leadership that says, how have we taken in the information, how are we reading the data, and how do we position our decision making for the long term and not just a meeting by meeting reaction to the data. So it is a very critical role. It's one that has to focus on the long run. And the design of this institution was intended to make sure that they were able to do that.
And yet we know, Esther, of course, President Trump is not going to be happy with the decision. I'm waiting for the social media post. I haven't seen it yet. I would bet good money it's coming. Does that pressure, does it matter ultimately, Esther?
Well, I don't think it matters so much in terms of the committee's decision-making process. And again, you see today that differences emerge in this committee and our public, so that the public understands where the debates are happening. But I think what's important, you don't want to confuse the public. And I do worry a bit when we see some of the disparaging remarks made about Chairman Powell and the Federal Reserve more generally. I wonder whether the general public understands the dynamics here that can affect their confidence in the institution. And that, I think, remains important for the Federal Reserve.
I don't know if you caught this, Esther. Mohammed Al-Arian gave an interview recently, and he was arguing Jay Powell should step down. The argument he was making, Esther, seemed to be, well, if he stepped down, that would actually it would diffuse a lot of this tension. It would minimize the attacks and would actually help preserve the independence of the Fed. What do you make of that call?
Yeah, I think the chairman, to be true to, again, the design of the institution, would be to carry and fulfill his term. I think that is really the demonstration of the independence of the Fed, the focus it's supposed to have. His term is not that much longer, and I suspect even whoever comes in behind him will have to face these same issues of thinking about the long-run interest of the American public.
Does the Fed, Esther, require reform in your opinion? I ask because, and you saw this, Treasury Secretary Bessent, he has called, and this certainly made headlines, got a lot of attention. He's called for a review.
Yeah, Josh, any democratic institution must be accountable and must be fully open. So I'll be interested in what particular reforms are being advocated for here. I think the central bank always benefits, and it's doing that now, right? Looking at its framework, thinking about what best serves the American public. So there's no reason not to hold the institution accountable. There's no reason not to think about whether the policy frameworks, whether the operating regimes they use are the most effective. But I would do that outside of a political leaning and try to do it in the most objective way possible in thinking about, again, how the public is best served by the decision making that goes on in this institution.
What about, Esther, I do want your take as well. An interesting thread here was the two governors dissenting. I was reading, Esther, that unusual. I believe it hasn't happened since 1993. What do you make of it? What does it suggest, Esther? What does it signal to you?
Yeah, it's unusual. I mean, I think we saw this when Governor Bowman dissented a few months ago, that hadn't happened in a while either. I think it's healthy. I think this committee, for too long, people have raised questions about whether its tight consensus looked more like groupthink than agreement. And that is not at all, I think, what the Federal Reserve is designed to do or intends to do. So I take these dissents at their face value, which is bringing forward arguments about a different way to look at the economy, a different policy preference in doing that. And the committee weighed those and came out in favor of leaving rates where they were today.
Esther, always great to see you and to have you on the show. Thanks as always for your time. Appreciate it.
Thank you, Josh.
Well, we are just minutes away from Fed Chair Jerome Powell. Sazi, as we head into this presser, Brian, what are you watching for? What are you listening for?
Well, I'm watching what some of the market's hottest stocks, how they've been reacting in the aftermath of this. I look at, of course, NVIDIA has been clinging to gains, AMD clinging to gains, even Starbucks clinging to gains from earlier in the session. If those stocks were going to start selling off into this press event, I'd be concerned. Now, having said all of that, I think there is a high bar to clear here for Powell. Why do you say that? I still think this is a bar or a market that needs a signal of a rate cut. And if they do not get any sniff of that, a word, a clue, anything at this presser, Josh, I'm not saying we're going to get a 5% correction, but we could see a little bit of a drawback here as market expectations retrench.
So if he just holds to the mantra, which is
data dependent.
We're data dependent. I've got an evolving situation here. Besides, I'm a central banker. I got to move with the data. That, in your opinion, that would be a disappointment.
I think it would be a disappointment, but it's what Powell, it's the pickle Powell is in. Companies are being
Say that
hit.
5 times.
I'm not doing it right now. I'm not getting embarrassed on live TV. I'm so psyched for this press conference. I'm so jazzed up. But anyway, companies are being hit over the head with tariffs right now. P&G's CEO told me yesterday, tariffs are inflationary. What is he doing? He's raising prices on Tide. That's inflation, Josh. How do you cut rates into that?
Now that is interesting you bring up that, because when I listen to Trump officials, I feel like a lot of times what their argument has been, Brian, is that you're kind of waiting to see where on the value chain the tariff falls. When I listen to the Trump officials, a lot of times they seem to be signaling, listen, you're all trying to figure out, is it going to hit Brian and Josh, the seller, the foreign producer? They seem to often suggest it's the foreign producer. That's who's going to get hit. But you know what we're going to hear from now? Jay Powell. All right, you were listening there to Fed Chair Jerome Powell speaking following the FOMC's decision to hold rates steady in July. Joining me now, we got senior markets reporter Josh Schaefer. Josh, we were listening intently to that Q&A. I know. What do you make of it? Your big takeaways?
Yeah, Josh, I mean, one of the key takeaways seems to obviously just continue to be this debate that we're seeing within the Federal Reserve, right? Of course, you have 2 dissents this time around. There's clear debate on whether or not they should be cutting or should have cut today, right? And so this reminded me of a chart that we recently had in our chart book. This came from David Merkel over at Goldman Sachs. And what they were looking at is core PCE over the next 2 years. And so everyone is sort of expecting this surge from tariffs, right? Over the next, call it maybe 6 to 8 months to mid 2026 is where Goldman sort of models it out. But then what Merkel, who calls for 3 rate cuts at the end of this year, points out and sort of sides with the dovish, like perhaps Governor Waller, he points out, well, then inflation gets back on a downward trend. And if you have confidence in that, then maybe that's sort of the dovish take here. If you don't have confidence in what the line is going to look like go out 6 months, and if inflation continues to pick up, then you're not as confident in cutting rates right here. And that seems to be kind of right in the middle of where this debate is. So what I was just pointing out there, again in purple, if you have confidence in that purple line falling down at the second half of next year, perhaps that lines up with your dovish opinion, right? But the concern would be where it gets real squiggly over that next 6 to 8 months. What if it stays squiggly for longer than we think? And that would be kind of the key concern.
What do you make the initial market reaction to this presser? I'm just looking at the popular averages here. I got the Dow down now about 250. Your broad gauge, the S&P's down about 0.2%. The Nasdaq flat.
Yeah, Josh. I mean, it's funny. We just kind of stare at the stock market while we listen to Powell, right, and try and figure out on our live blog on Yahoo Finance why the market's moving. And normally there's kind of a clear line, and today there wasn't exactly a clear thing that he said. It happened at about 250. Stocks went negative. You can see that on your screen there. And in that moment, he was answering a question talking about, he said you could, quote, argue we are a bit looking through goods inflation by not raising rates. That was the only time he really mentioned the concept of raising rates throughout the entire press conference. So that was when the market moved. Personally, what I exactly make of that, I don't really even know if that necessarily matters, Josh. The market moved. But that seemed to be what spooked markets a little bit. Powell also did talk a lot about it being the early days of this tariff impact, right? So what happens moving forward sort of remains a key question, right? We are not that far in to this tariff process, which of course is a moving target too.
Anything that surprised you in that conference, or did he play it right down the middle in your opinion?
I think he probably played it pretty straight down the middle, right? I don't think there was a ton surprising. He was asked directly about September. He did not bite. Very rarely does he bite when he's asked about an incoming meeting, right? He's going to say, we'll get more data. And so I don't think there was too much surprising. And again, we're talking about the market being down. The S&P 500 is right near a record high, and it's down about 50 basis points.
Yeah, down about 0.4% right
So
now.
really, not a huge move, right? I don't think it was a massive market moving event either to the upside or the downside, and sort of like we expected going into it, right? I don't think a lot of people expected this to be the key event for the stock market.
Yeah, which I think we could argue. Jay Powell, what he'd prefer. He'd prefer not to get it tomorrow morning and see his face top of the fold, market crashes. Yeah, that makes sense. All right, thank you, Josh. For more reaction to Fed Chair Jay Powell's address, we have JP Morgan Asset Management Global Market Strategist. That would be Jack Manley, along with EY Chief Economist Greg Dacco. Guys, great to have you here. Your reactions. First question was right out of the gate was rate cut in September. Is it happening? What's going on? And Powell sort of saying here, listen, we've made no decision about September, Greg, he says. So more of the wait and see there. He was not teeing that cut up in the presser. Obviously not going to go over too well with the president, we know. I'm waiting for the social media post, as we all are. Bloomberg does note the chances of a September rate cut. They went from 68% yesterday to just 45% now. What do you make of the question and then his response to it?
Well, it was largely expected that he would keep his cards close to his chest when it comes to what he's going to do next because they're highly data dependent. I found one thing that was quite interesting is that he said there was no evidence that monetary policy was having a restrictive effect on the economy. That's a hawkish statement.
Right.
At the same time, he also said that the base case was that tariffs would have a one-time price increase effect. That is a dovish signal that aligns with Waller's view. And then finally, he did say that the economy looked quite solid. I think he was putting a little bit of lipstick on the economy there because he kept coming back.
Why do you say that, Greg?
He kept coming back to the downside risks. So he said the economy looks solid, the labor market looks solid, consumer spending is slowing a little, but then he always kept saying there are downside risks to the economic outlook. I think that will position the Fed to, over the next few months, gradually see the evidence of this demand erosion and open the window for a potential September rate cut.
Yeah, Jack, he talked about how there are many uncertainties left to resolve, he says. We're learning more and more. Doesn't feel, he said, like we are very close to the end of that process, he said. What did you make of it?
I mean, I think that's sort of a given that we're not close to the end of the process from a tariff perspective. I mean, we're still finalizing rates as we speak. Literally, these things are rolling out over the course of the days, over the course of the weeks. And when you think about the logistics behind shipping goods over from overseas, the timing behind inventory builds, it is natural that it's going to take a little bit more time before these tariffs actually start to hit prices, wherever they start to hit prices, whether it's in corporate margins or with consumers going out there and spending a little bit more. He highlighted that uncertainty. Look, it makes a lot of sense. It's a word we've all been using for a very long time. Things are uncertain. He also downplayed, Greg, to your point, any sort of commentary about softness in the labor market, which I thought was very interesting. And as we talked about earlier, I don't necessarily agree with. I mean, yes, the unemployment rate is quite low, and yes, payroll gains are positive. But when you look at what's going on with the growth of the labor supply, there are some really serious handicaps to that number coming up. Our demographics are already pretty bad. Major changes to immigration policy that will only accentuate those weaknesses that we have domestically. The one interesting thing that I found, and for what it's worth, I actually do think this press conference was more interesting than I expected, maybe a little bit less entertaining than I expected. I think this was a little bit more.
You can't have it all, Jack.
I can't have it all. I got a little greedy. I'm stepping back. I'm eating my words. I'm saying, look, this was a little bit more interesting than I expected, and it does have to do with some of that commentary about are rates neutral right now or are they not? And to your point, Greg, right? I mean, Powell very clearly said that rates right now are not having a restrictive impact on the economy. But the way that he phrased it, at least to my mind, almost made it seem like there was a ... after that, where it was, but I wish they would be. Very clearly he was saying that rates are not neutral at the moment. We're not in a neutral position, because if rates were neutral, as Powell said, then they would be lower than where we are right now. That to me was very, very interesting. This idea that rates are in restrictive territory still, and I'd love to know why Powell thinks that we need restrictive rates. Like, maybe we're not arguing for a loose monetary policy, but why not just neutral? That to me is the big question right now.
Why not just neutral, Greg?
Well, I think one of the interesting elements came at the very end of the press conference, where he said that this was one of the most interesting FOMC meetings that he had attended, because the conversation was so rich. You had Bowman and Waller likely arguing for an easing of monetary policy, so there were debates around the rationale for either a moderately restrictive monetary policy stance or a more neutral one. And Fed policymakers don't have the luxury to, have much of a forward-looking, risk-taking approach. We do as economic forecasters. And when I look at the outlook, I'm seeing a couple of things that will materialize with greater visibility over the coming months. One, inflation is going to pick up. That is a given the fact that inflation is going to pick up from tariffs.
When it picks up, Greg, your point, though, correct me if I'm wrong, when it picks up, you then expect it to ease and subside? You don't think it's persistent?
No, I think it's a 9 months to 12 month phenomenon. You're going to see higher prices for a while. That will lead to higher inflation, but then we'll see essentially inflation moderate. You're not going to see prices continue to rise at a rapid clip over the course of the next few years. That, however, is going to come on top of very large price increases that we've seen since COVID that will further erode consumer spending power. If you look at consumer spending in the first half of this year, it only advanced at an average pace of 0.9%. You know how fast it was growing at the end of last year? 3.9%.
Yeah.
That's a big, big slowdown in the first half of the year.
Which, by the way, dovetail Powell's comments in the consumer are saying generally good shape, but then did add, isn't spending at a rapid pace. You didn't mention that.
Not at all.
When Jack brings up this point too, and I want to get your take, Greg, on where the tariff kind of lands on the value chain. Is it Greg and Josh, or the seller, or the foreign producer? Powell was saying there, seems like costs being borne mostly by companies and retailers. It's starting to show up in consumer prices, and he said we expect more of that. What do you make of those comments?
I think that's absolutely on point. We're not seeing any decreases in exporters' prices to the U.S. So essentially everything for the big part right now is being burdened by corporations, by retailers. Some are trying to pass it on to consumers, but consumers are extremely price elastic. They're very reactive to these price increases, and you're seeing volumes decrease as a result of these price increases. So that's very much the case right now. I'll add one more thing that we haven't seen yet. The effective tariff rate in July was 10%. The average tariff rate announced was 15%. So there's much more tariff bite to come. And over the course of the next few days, we're going to see the average tariff rate rise from 15% to about 18%. So the shock is getting greater and greater. That will weigh on economic momentum. It will weigh on the labor market. I am concerned about this print over the course of the month of July. I think we will see very weak payrolls, and I think that will start to sound alarms amongst Fed policymakers that perhaps it's more than time to start easing monetary policy.
Jack, I want to end with you here. Yeah. Did you hear anything today, Jack, that in any way influenced, impacted, changed how you think investors need to be positioned here?
Not particularly, frankly, because A, I mean, there were no big surprises out of this meeting, as more or less we expected, I guess, definitionally. And B, we've been playing somewhat defensively really since the start of the year, right? I mean, where we are right now is not a single point in time, but a continuation of a trend that's emerged for the last 8 or 9 months, which is there's a whole lot of uncertainty because there's a whole lot of change underneath the surface. And whatever's going on with tariffs and trade, right, Greg, to your point, like those numbers keep on changing. Put that stuff aside. You got changes to the regulatory environment. You got changes to immigration policy. You have changes to the fiscal side of the house. There are a lot of things happening simultaneously. They are all having impacts, positive and negative, on all these different economic indicators.
Given that backdrop, Jack, what is your advice then? How broadly do you want to be positioned?
My asset allocation views are so boring, Josh, but they seem to work well.
Boring can work just fine.
I like short to intermediate duration, high quality fixed income. I'm not going all the way out on the curve, unless in case we get a massive spike in 30-year yields because the Fed loses credibility or the semblance of independence. I'm not extending into credit right now. Not that there's anything wrong, but spreads just don't justify the fact that there is some macro risk sort of hovering over us. That sort of Damocles, right? That's always something that we have to be somewhat worried about. On the equity side of things, again, boring. I like large cap stocks. They're high quality. They're stable. I like U.S. stocks, despite the international run that we've seen through the start of this year. I am a big believer that this U.S. exceptionalism story from both an economic and market perspective is continuing. What we've seen recently has been a blip, not a regime change. And within those U.S. large cap companies, so we're talking S&P 500, I'm kind of splitting the difference right down the middle. I'm value growth agnostic. It's a bottoms up security selection market. It's active management. That's it. Not rocket science, but it seems to be working pretty well.
That's it. Keep it simple. Jack, Greg, great to have both you guys on set. Thanks so much for your time today.
Thanks.
All right, let's go now to Yahoo Finance's Fed correspondent, Jennifer Schonberger, who was in the room for Fed Chair Powell's press conference. Jen.
Hey there, Josh. I was watching closely to see whether Fed Chair Jay Powell would open the door to a rate cut in September, and I didn't really see him crack that door open. He basically said, we haven't made any decisions about September at this time. He didn't want to tie the Fed's hands, saying we have a lot of data that is still going to come in between now and September, and we'll make a decision at that time. These comments coming even as the Fed downgraded their assessment for the economy, calling it economic activity moderate as opposed to solid. Take a listen to what the chairman had to say about monetary policy's stance right now in light of the data.
The economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate.
Now, Fed Chair Powell says it's still early days when it comes to assessing the impact of tariffs on inflation. He says right now it seems that the importers and companies appear to be absorbing most of the costs, but in surveys that they are hearing from companies and taking their temperature, they do intend to pass on costs to consumers. So it seems like Fed Chair Powell and many members of the Fed, excluding Fed Governors Bowman and Waller, believe that we will see more inflation pass through from tariffs as we go later this summer. Though Powell did say the base case right now is that it'll only be a one-time increase in prices, not something that's more persistent. Of course, he said if it were to become more persistent, then the Fed would make sure to nip that in the bud and keep rates elevated. Now, when it came to division, because we did see two members of the Federal Reserve, Fed Governors Mickey Bowman and Chris Waller dissent, something that we haven't seen in 30 years' time. He said he called this a really good meeting. He says everyone was very clear in recounting why their view was their view and assessing what the economy, the stance of the economy is and what the appropriate monetary policy would be for this point in time. Of course, we're going to have to wait for the minutes to get a little bit more on that, as well as statements from those two Fed governors, which are expected later this week. Powell was also asked about the impact of lowering rates on government borrowing costs, something that President Trump has been calling for. Take a listen to what Chair Powell had to say about that.
It's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy.
Powell also reflected on President Trump's visit to the Federal Reserve's headquarters, which are under renovation at this time, and a point of contention between the president and the Fed, though the Fed chair said it was an honor to have him visit. Take a listen to what Powell said on that.
We started out to do the work, and we're very well along on that work. And I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Now, when it comes to Fed independence, Powell said, we don't really want to use interest rates to impact elections. That really hasn't worked well for other countries. And lastly, Josh, real quick, on the tax bill, he doesn't really see any major stimulative effect to the economy because it is just keeping tax rates at the same levels that they have been over the past 4 years. Back to you.
All right, Jennifer, thank you. Appreciate it. Well, that concludes our Fed Day coverage. Market domination begins right on the other side. Welcome back. It's time for Market Domination. I'm Josh Lipton, live from our NYC headquarters. We've been locked in, of course, on the Federal Reserve's July decision to leave rates unchanged for now. We have more reaction to that decision, along with, of course, big tech earnings. That's come up later on. We're under an hour away now from the closing bell, and right now seeing stocks dropping on the Fed rate decision, as well as fresh tariff news that President Trump slapping an additional 40% tariff on Brazil. So just checking the popular averages. Dow's down about 300 points. The S&P 500, your broad gauge, is down about 0.4%, and the NASDAQ down about 0.1%. All right, looking now at some of the day's trending tickers with Yahoo Finance's senior reporter, Ali Canal. Let's start here with Electronic Arts, the company reporting first quarter net bookings that did top expectations. Ali, what do you make of it?
Yeah, so we're seeing shares jump right there around 6% after the video game maker posted better than expected quarterly results, strong performance in its core gaming business. That helped offset some concerns around a softer forecast for the current quarter. The company did blame that on the timing of game launches along with higher marketing spend. But despite all of that, we initially saw shares dip a little bit on that news, on that softer quarter, but then investor sentiment started to shift a bit. We had Wall Street analysts come out and turn a bit more bullish. Bank of America, for example, boosting its price target, helping drive the current rally that we're seeing. The stock is now trading near its 52-week high. It's been gaining ground this year as confidence continues to build around its gaming pipeline. I'm taking a look at a year to date right now. We are up over 7%. And, I was talking to one of our producers who's a big gamer, and he said that EA is pretty much one of the only games in town, no pun intended, along with Take-Two Interactive. Although Take-Two Interactive, that stock has been on a tear since the start of the year, up around 20%. EA has games like Madden, for example, which I know is popular with a lot of the gamers out there. So, we'll see. I think, too, when you talk about a potential softening on the consumer side, what are they going to do if they're not going out there and spending on outside of the home experiences? Maybe they're going to spend a little more time on the gaming side and purchasing some of those games.
And that producer you're referring to, I mean, I would take that producer's word on games.
Yes, he's hardcore.
That's a good source. That's a good source. I see Colin Sebastian over at Baird. He's a smart guy. Been doing this well. He likes this name, Electronic Arts. Tells his clients it's outperform, it's a buy. Says EA reported another solid quarter above expectations. Says not surprisingly, they maintained 2026 guidance, which now embeds more conservatism, he says, given healthy portfolio trends, positive early feedback on Battlefield, and some FX tailwinds. All right, looking here at another one. Steve Madden, that company missing earnings and sales estimates for the second quarter. Retail company also not providing an outlook for the rest of the year. Your thoughts, Allie?
Oh gosh, this is a company that's just
look at that.
struggling. 10% off today. Year to date, we are down about 45% here. So we have weak second quarter results with withdrawal of that full year guidance. Now, they did cite pressure from new U.S. tariffs. So the company swung to a loss, declines in both wholesale and direct to consumer sales, excluding the impact of that Kurt Geiger acquisition. They are seeing some benefits there. However, with Geiger, there is a lot of exposure to China. So management has been trying to shift a lot of that production outside of China, but a lot of the Geiger acquisition that remains exposed to that market here. There's uncertainty around the trade policy, as we know, uncertainty around consumer demand, obviously weighing heavily on a name like Steve Madden. And also in the footwear space, there's just a lot of competition. I feel like it's really hard to stand out. I mean, personally, for me, Steve Madden was a big thing back in the day. I can't say that I shopped there recently, so maybe that has something to do with it.
Investors don't seem that enthusiastic. No. This stock has been shelled year to date. Oftentimes you see a stock get hammered like that, you would have the street kind of move in, like, okay, bad news is in there. I mean, look at that chart. But still, most of the street here, 60% of analysts who are paid to tell you what to do, at a hold. Four buys, got 6 holds, 0 sells. Finally, shares of Harley-Davidson surging. Despite tariffs weighing on profits in the second quarter, the company announcing a strategic partnership with KKR and PIMCO to unlock roughly $1.25 billion of discretionary cash, Allie.
Now, this company also reported earnings, but this has nothing to do with earnings because it actually was a rough quarter for Harley-Davidson. Showed steep drops in revenue as well as motorcycle demand. You want to talk about the consumer, they're pulling back on buying some of those bikes. Now, Harley did blame tariffs and economic headwinds for the weakness, held off once again on issuing full year guidance. So keeping the outlook a bit cloudy there, despite the rally that we're seeing on the heels of this KKR PIMCO news. Now, this deal from Harley, it centers on their financial services arm and will give the company cash to pay down debt and buy back shares. So we are seeing that 13% pop today. I will say, though, year to date, we are down 13% despite the gains that we're seeing. So still a company, again, very exposed to the consumer here that is struggling, which we have seen from a lot of these names with consumer exposure, especially at a time when consumer discretionary is breaking down a little bit. We are seeing some cracks underneath the surface. And then we just heard earlier today from Jerome Powell about how goods inflation is starting to tick up to a level that they're maybe not totally comfortable with. So all things to watch here as we continue to monitor the economic outlook.
You see Harley-Davidson CEO here did make comments, talks about the fluid global tariff environment, saying negative consumer sentiment, a challenge for the business. Did say, though, ongoing engagement with various governments gives us cautious optimism that future trade agreements may help limit the overall impact on our operations. There you go. Allie, thank you. Appreciate it. From the Fed decision to our next big story of the afternoon, that would be big tech earnings. Microsoft and Meta reporting after the closing bell. Yahoo Finance's Dan Howley joining us now with a closer look. Dan.
Yeah, Josh, we're looking for Microsoft to report more of its earnings around AI and what that means for its cloud business. Now, obviously, last quarter, they had seen growth in Azure, but they attributed some of that to non-AI related growth. So we're going to see whether or not that continues or if we see more of an uptick in AI this time around. Last quarter, they also said that they attributed 16 percentage points of growth in Azure to AI. We'll see what the street's going to get there. They're looking for 17.5%. Could be higher, obviously, if Microsoft managed to get more capacity online, something that they've been discussing a lot, that they're capacity constrained because they can't get access or can't stand up data centers as quickly as they'd like. And there's also talk about the obvious business side of things when it's their productivity software, their Office 365, Copilot, whether or not that's bringing in more business over time. And then on the Meta side of things, it's got to be the discussion about this huge AI spend that they're doing when it comes to hiring talent. There was a report that they were looking to get people from upwards of $1 billion when it came to these kind of payouts that these people would get. There were previous reports of $100,000 to $200,000. So obviously, they're willing to dole out the cash for the talent that they want, and they're kind of pushing this idea of personal superintelligence. Now, they've already talked about how AI has helped them when it comes to their ad side, giving some advertisers the ability to build product that they can then show to consumers. And then on the user side, with getting people to dwell more on their apps, which is obviously the big thing that they want. It's why there's an endless scroll when you go to Reels, things like that. But they're talking about the personal superintelligence. Mark Zuckerberg discussing that this morning in a post, saying that they want to take a different route than their competitors like OpenAI or Perplexity, Microsoft, and focus more on getting people to be more creative and less on taking away work entirely. So we'll just have to see what kind of more commentary he has there, and then what investors and analysts think when it comes to all of that spending.
Dan, how do you think Zuckerberg thinks about sort of his company's place and role and competitive advantages in that broader AI market?
Yeah, I think, obviously there was this, there's this narrative that their Llama 4 behemoth just hasn't been up to snuff, right? That's why we haven't seen it yet. There was a Wall Street Journal report that it's kind of delayed until maybe the end of the year. It was supposed to come out earlier this year, and now it's kind of just off the table. And so, as a result, it looks like they've decided, okay, well, we're just going to hire as much talent as we can and see if we can stand this up. They also set up that superintelligence lab that they have now. That's where a bunch of those hires are going. And what Zuckerberg was talking about this morning in his kind of essay about where he sees AI going. I think as far as the advantage goes, though, it seems as though it's easier for them to show how AI is benefiting their business specifically, right? They can say, okay, this is where advertisers are using AI and it's how it's benefiting them. This is how we're using AI and it's benefiting us by making people want to stay on the apps longer. And I think it's just easier in general for them to show that. Now, look, they're also investing heavily in hardware. They have their Ray-Ban Meta glasses. They also launched their Oakley glasses. Zuckerberg has talked about how this AI that they're building out is going to kind of feed into those products over time. They'll have standalone glasses is their hope. They have that Project Orion where it was, if you see pictures of stock photos of Zuckerberg, they're very thick-looking black glasses. That's those. They're kind of an alpha or beta format of what the glasses would eventually be. But that's where they're also hoping to push this. But like I said, it seems as though for now, when it comes to their core business, it's easier to see the effect of AI and the positive impact for them than, say, Microsoft, which isn't giving exact numbers on AI, or Google, which isn't giving exact numbers on AI, or any of their competitors, really.
Dan, thank you. Appreciate it. Well, fresh trade news now to report. President Trump signing an executive order imposing a 40% additional tariff on imports from Brazil. That raises the total levy to 50%. The White House says the tariffs will be effective in 7 days. The move coming in response to recent Brazilian policies that the Trump administration says are at odds with U.S. interests. Now, additionally, the U.S. plans to impose a 25% tariff on goods from India and an additional import tax. President Trump saying that is due to India's purchasing of Russian oil. Trump has said on his Truth Social platform that India is, quote, our friend, but India's tariffs are far too high. And the latest round of tariffs do come after 2 days of talks in Stockholm between Chinese and American negotiators. Officials from both nations agreed to seek an extension of their 90-day tariff truce. Trump has reached tariff agreements with the European Union, Japan, the Philippines, and Indonesia, all of which he says would open markets for American goods while enabling the U.S. to raise tax rates on imports. Well, big tech now on deck. Stick with us. We're crunching the numbers for Meta and Microsoft. That's coming up. Another trending ticker today, shares of Ambiq soaring after the stock made its public debut on the NASDAQ. The ARM-backed chipmaker raising $96 million, making it just the second U.S. company since 2022 to IPO with less than $100 million in sales. Ambiq makes ultra-low power semiconductors for AI applications. And joining me now, we've got Umi Asaka, CEO of Ambiq. Umi, it is good to see you, especially on set.
Thank you for having me here.
Start here, Umi, for the viewers, for the uninitiated. Just walk us through the company's mission. You know, what's the problem you're solving for, Umi?
Again, our company's mission is solving power problem on semiconductor. So we have a technology that allows semiconductor to operate with one of the lowest power solution. And that really allows a lot of product, like Edge AI product, to be more meaningful and more functional.
So to compare and contrast your chips with traditional chips, no problem. You're with it, Umi. See, your fans are already calling in. That's the issue. It's a big day. They want it. They want
Sorry about that.
Umi, let me ask you.
Yes.
So I want to understand you right. If I compare and contrast your chips to traditional chips, the difference is you're delivering lower energy consumption.
Exactly.
Can you quantify for us how much lower? Is it 3 times lower, 5 times lower?
And we are typically close to 5 times better than other semiconductor chips. So our phase one of the company was, we're 15-year-old companies. And we, in the phase one was really enabling battery life to last much longer. So we were and we are still in many smartwatches.
So it's wearables, that's where you're playing.
Well, we used to play in wearables. And, in old days, if you remember that the smartwatch lasted about a day or two, and our technology allows a smartwatch to last, our customers' watch last about 2 weeks to 3 weeks.
Wow. And is it just watches, Umi, or is it other wearables? Are you on
other
glasses?
Wearables as well,
Okay.
AR glasses, smart ring, and some of the medical devices. So we're enabling a lot of Edge AI functionality in all of us around your life.
So those are the devices. What brands, Umi? What are the companies you're partnering with?
Again, we have many companies that are supporting us, and that's why we are very happy today that a lot of people seems to believe in Edge AI growth. And I believe that's why we get to see this kind of shareholders support.
When I think about the wearable space, I think a lot of people move to that space because of the health applications.
Exactly.
Right?
Exactly.
Elaborate on that. Why does that excite you?
Well, again, think about just like AR glasses. Okay, I know a lot of people will wear it for just fun of it. Okay, but for me, it's prescription glass becoming really, really more intelligent. So I mean, you're so young, But when I
Not that long. I mean,
when,
really not,
when
no.
you get to my age,
what you're responding to me, it's professional makeup and lighting.
Oh
That's
yeah,
really what
okay,
you're saying.
okay.
Yeah, that's really...
But when you get to my age, bifocal lens glasses are horrible. Okay, so I usually have to take up to read some of the small characters or the screens. But when you have AI, it's going to really understand what you're looking at. And you're going to be able to read without the latency. That's a problem. Your eyes need to adjust based on bifocal lenses. You will be able to just look as quickly as you need to. And those kind of medical and those kind of wearables, medical, it's really becoming we used to consider medical devices, industrial devices, and consumer IoT devices one vertical. AI is becoming horizontal. And that's why medical, something like that example of prescription glasses are going to be something that really going to make my life much easier when I hit about 70 years old. And I can tell you that when I reach that age, I think my life is going to be completely better than the ones that living today as the age of 70.
Final question. You mentioned at the top, you guys have been around a while. I think you said 15 years. So why make the public debut now? I mean, what are the variables that went into that decision for you?
Again, extending the battery life was great. And we had a great customer reception, and I think we had a great customer support. And I think if you walk around the airport, hospital, offices, our product is already in use. We already shipped 270 million units already. But we needed to go to the next phase because, well, thanks to the AI awareness. 2022, thanks to ChatGPT, Gemini, and those AI, everybody started thinking about AI more. And AI adaptation in the edge became more active. And customer needed more function that they wanted to build into the wearables and some other medical devices, AR glasses in so many places. But one problem, energy. If you don't have a meaningful battery life or meaningful function, it's going to be a toy. But for them to be really the product that help your life and the way that you live, really the power consumption is everything. Again, AI, always we talk about AI, and even, all the, big AI data center guy says the power is the biggest problem. And that's what we're solving. That's why we start with, edge AI, but our technology Spot platform can be applied to any semiconductor. And we are doing IPO because of the fact that we have so much demand, and we needed to fund more engineering to expand into the wider segment and market sectors. That's why we did IPO.
Umi, it was great to have you on. Send congrats. Big day for you, big day for the company.
Thank you so much.
Thank you so much.
Thank you.
Well, we are wrapping up today's market domination, but don't go anywhere. We're moments away from the closing bell, and after it rings, the earnings fun begins. Stay tuned for market domination overtime.